Global Equities rebounded 16% in the first 4 months of 2019, but fell 6% in May, largely due to trade tensions between US and China. Fixed income markets rose 3 to 8% up to this year. As market volatility continues to be elevated, how should investors position their portfolios to navigate through the uncertainty? We speak to Citi strategists on an outlook for the second half of the year. Ken, there are rising concerns about the global economy losing momentum. What is Citi's view on this outlook?
Well, we do think that global growth will be slowing down from what it was last year, but I think still well supported at between 2.5% and 3%. Now, in the US, the effects of the tax cut are obviously already fading. We do still think that we could do about 2.5% in the US. In China, the amount of policy easing that has been put in place last year and this year is so significant that we think liquidity and credit should still be supportive, and hence, at the end of the day, we still should be getting somewhere above 6% growth. Now, with all that said, we are in the middle of trade tensions, pretty significant ones, and we think this is likely to become a more drawn-out conflict between the US and many other parts of the world, not just China. And so that has become probably the greatest risk to this generally sanguine global view.
The bull market just turned 10 in March. Does it still have legs to run, given the backdrop you've just described?
Well, you're right. We've actually had a very long and pretty good run. Coming into the summer, we have significant changes or deterioration in the trade outlook, and that's probably going to keep markets on edge for the coming months. And we do think in the US, for example, the valuations and the potential remaining growth if we're left in this cycle does not really leave that much money on the table. So with those two considerations, we need to be very cautious about US equities and be very selective. In Europe, we are worried about things that are well known, right? So Brexit, and also the US trade offensive is reaching Europe as well. But the valuations there are not terribly demanding. So, some sectors could be attractive, such as healthcare. Where we see the greatest longer term opportunity is still here in Asia. EM Asia is the only region really in the world that has enough heft and also is growing substantially in terms of final consumer demand. Asia, MSCI Asia ex Japan is trading at 22% cheaper than the US in terms of forward PE, and China is trading at 33% lower. So this growth versus valuation profile, we feel, is the best opportunity for the longer run.
The Sansan, US rose interest rates 4 times last year. Chairman Powell recently came out to signal that he's watching the US trade negotiations very closely, and should matters deteriorate, they're open to taking action. What is Citi's view on this?
Markets are expecting Fed to cut rates in 2019 as well as 2020. Now, what actually pans out is going to be very dependent on the trade negotiations. Now, should the financial conditions deteriorate, or if the negative impact of trade spills into the domestic economic activities, then Fed will be compelled to act and to cut rates. Now, we believe that the Fed is more likely to be reactive to trade developments than to be proactive.
In this environment for lower for longer interest rates, what are some of the bond opportunities that you see for investors?
So we do like the US investment grade corporates, especially those in the 5 to 7 years to maturity brackets, primarily because of the higher yields as well as the wider spreads. Now, despite higher volatility, we are also constructive in terms of the emerging market debt as well. Now, in Asia, we are overweight in terms of dollar-denominated debt, as well as the local currency-denominated debt as well. We believe that the Chinese policymakers are going to be supportive in terms of financial conditions that will help to cushion any impact in terms of the trade tensions. So in that regard, we do like the property names as well as a high-grade state-owned enterprise credits.
Chair, the US dollar has been strong since 2019. What's the outlook for the second half of the year?
Well, the US dollar has certainly been a beneficiary of the rising risk aversion environment that we are in, caused by rising trade and geopolitical tensions, as has the Japanese yen, the Swiss franc, and gold. Unfortunately for the US dollar, markets believe that as these trade tensions intensify, it will ultimately come back to negatively impact the US economy, forcing the Fed to respond by lower rates. And lower rates would undermine the dollar sentiment. So, in a true sense, the safe haven currencies of the yen, the Swiss franc, and gold are really where the opportunities lie. Now, if you turn to Europe, the sterling is being hampered by rising risks of a no-deal Brexit, and the Eurozone continues to be hampered by the weak fundamental backdrop and as well as rising US-European trade tensions.
And what's the outlook for the Asia-Pacific currencies?
The outlook will be driven primarily by what happens to the Chinese renminbi. Now, at the present, the People's Bank of China has indicated it wants to stabilize the renminbi at a level below 7, primarily to discourage capital outflows. But if the US-China trade dispute escalates to the next level, and the PBOC may allow the renminbi to weaken beyond that, in which case the rest of the region, currencies like the Singapore dollar, Korean won, Indonesian rupiah, Malaysian ringgit, Thai baht, they will all feel the negative impact of a weaker renminbi. Now, the commodity currencies, the Australian dollar and New Zealand dollar, are not going to be better off either. They are also correlated to the direction of the renminbi. And you've got to remember that their own central banks have been cutting rates, so that is also undermining sentiment in the Australian dollar and New Zealand dollar. The place to go to is the Canadian dollar, where the Bank of Canada has been fairly upbeat about the domestic prospects, and the Canadian economy is not as exposed to China, say, as Australia or New Zealand.
We hope you found these insights useful. For more information, please contact your Citi Gold Relationship Manager.